weekly review of the U.S. economy. I am Glenn Ford Robinson. U.S. economy stares recession in the face. 25% interest rate cut expected by Fed on Wednesday. U.S. existing home sales, new home sales, and durable goods orders tumbled in September. Released by the National Association of Realtors, the existing home sales report measures changes in the annualized number of existing residential buildings sold during the previous month. This report assists in gauging the strength of the U.S. housing market and functions as a key indicator of overall economic strength. So a subpar reading would indicate overall economic weakness, and a higher than expected reading would indicate overall economic strength. Let's see what reading was released. On Tuesday, October 22nd, 2019 at 10 a.m. New York time, the existing home sales report for September missed forecast of 5.45 million, posting a dismal score of 5.38 million, much lower than the previous reading of 5.50 million. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. The current existing home sales reading missed forecast. Therefore, the U.S. housing market and the U.S. economy currently show weakness, and so does the U.S. dollar. Some traders and investors sell the weaker currency in a currency pair, and some traders and investors buy the weaker currency in the hope that buying at the low price or at low prices will provide profitable gains when the currency rises in value in the future. The Federal Reserve keeps a close eye on economic reporting data, such as the existing home sales report, and a subpar reading such as the 5.38 million should cause the Federal Reserve to cut interest rate in order to jumpstart the economy. In fact, we predict that the Federal Reserve will probably cut interest rates this coming Wednesday, October 30th. It would be highly surprising if the agency does not cut interest rate. The U.S. Census Bureau new home sales report measures the annualized number of new single-family homes sold during the previous month. The report plays a more impactful role when released ahead of the existing home sales report, because the reports tightly correlate with each other. The report came in well below forecast, posting a reading of 701,000, missing forecast of 710,000, and a previous reading of 706,000 on Thursday, October 24th, 2019 at 10 a.m. New York time. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. Based on the current new home sales report, the U.S. economy continues to show slow growth, signaling that the expansion phase of the business cycle could be coming to an end. The economy began expanding from June 2009, right after the stock market crash of 2008, until now, 11 years later. Yet another confirmation that the U.S. economy has indeed fallen on hard times. The Federal Reserve usually jumps into action during these trying times by implementing monetary policy tools such as cutting interest rates and providing liquidity to the financial system. These current new home sales numbers serves as another indication that the Federal Reserve will possibly cut interest rate this coming Wednesday. The U.S. Census Bureau core durable goods orders measures changes in the total value of new orders for long-lasting manufactured goods, excluding transportation items. Because Aircraft orders are very volatile. The core number gives a better gauge of ordering trends. Higher readings indicate increased manufacturing activity. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. The core durable goods orders for September came in at negative 0.3%, missing a less impressive forecast of negative 0.2%, and well below a previous reading of 0.3%. These results tell us that consumers have stopped buying durable goods items, which further confirm the decrease in existing home sales and new home sales. No new homes changing hands means no purchasing of refrigerators, stoves, bedroom sets, or other durable items. Companies belonging to cyclical industries produce durable goods items. What is a cyclical industry? A cyclical industry and companies within it depend on the business cycle or economic cycle for profitability. This means that when the economy or business cycle enters the expansion phase of the business or economic cycle, cyclical industries and companies prosper with large profits and high employee retention. However, when the economy enters the negative or slow phase of the business cycle, such as the stagflation and recession phase, profits decrease and employee retention decreases also, producing large layoffs, thereby supplying large numbers of unemployed people to the economy, thus further slowing down the growth of an already slow-growing economy. As a result of these economic obstacles, U.S. recession fears prevailed and the Federal Reserve will step in and cut interest rate even lower this coming Wednesday from its current 2.0% mark to 1.75%. I know that I sound like a psychic, but what do I have to lose? Absolutely nothing. And a lot to gain from fine-tuning my psychic ability. In fact, if I am wrong, it won't be the first time. But if I'm right, then I am a genius. I just need to be right once. By the way, my first son's name is Genius. That's a fact, really. Companies within cyclical industries produce durable goods and suffer when the economy slows. Non-cyclical industries and the company within them, on the other hand, do better when the economy slows. These companies play the role of recession-proof companies. Companies in the insurance, utilities, medicine, water, and personal hygiene fits this category. It doesn't matter how slow the economy gets, people will still need to brush their teeth, pay their utility bills, and pay their car insurance. Cyclical companies produce durable goods, items such as dishwashers, bedroom sets, refrigerators, and other big-ticket items. These items usually find themselves on the secondary priority list, not the first priority list, as do these recession-proof items. Therefore, during trying economic times, like now, consumers bypass purchasing durable goods items, causing companies producing these items to underperform in the stock market during slow economic growth periods. I won't go into specifics as to which companies belong where and what stocks are involved. I will leave that up to your professional advisor, and that's your professional investment advisor, who will advise you on such specifics. I am just your financial information provider, not your advisor as yet. Most people's 401k statement had negative returns this past quarter and continued slow economic growth from the past few months. Should be blamed for that. Yeah, really. How did I know that? Would you like to know? Well, it's just obvious. The Mortgage Bankers Association MBA Mortgage Application Report measures changes in the number of new applications for mortgages backed by the MBA during the reported week. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. So, how do you think our MBA mortgage application report did? Do you think it did good? Or did you think it did bad? Put your answers in the comment area below the video on YouTube. Well, on Wednesday, October 23rd, 2019 at 7 a.m. New York time, the MBA mortgage application for the past week, ending October 18, 2019, came in at negative 11.9%, well below the previous week's reading of 0.5%. This result represents the largest decline since October 9th of 2015, when refinance application went down 17.1% and application to buy a home fell 3.6%. On the global front, the Turkish lira rose on Wednesday after U.S. President Donald Trump lifted sanctions on Turkey for implementing permanent ceasefire on the Syrian Kurds. Wow. In the middle of the month, the Turkish military attacked northeast Syria and the U.S. immediately imposed sanctions. The Turkish lira jumped 1.4% to 5.723 after the announcement. The highest value of the currency has risen since the beginning of October at around 11:50 a.m. New York time. Why am I talking about the Turkish lira? Am I talking about the Turkish lira because I'm talking about the Turkish lira because many of my friends are Turkish and they help me in my business endeavors. Simply as that. Investors continue to keep an eye on Brexit developments after British lawmakers approved the withdrawal agreement bill, but then rejected Prime Minister Johnson's withdrawal timetable. Extension after extension continues to dominate the face of the UK Brexit deal. This past Friday, European Union officials delayed the decision of how long an extension of the Brexit deadline they should allow the UK. In fact, without a hard deadline, members of the British Parliament have little to no incentive to reach a compromise across party lines. This has always been the prevailing problem facing any Brexit deal. Well, you know what? Well, will there ever be a Brexit deal in our lifetime? I don't think so. I feel very bad, though, for the consumers who will continue to pay the economic price for Brexit. The New York Federal Reserve poured $77.343 billion in liquidity in the financial markets this past Friday. The Fed said the agency took in $67.593 billion in U.S. Treasuries and $9.75 billion in mortgage securities in a repurchase agreement operation that will expire Monday. This monetary policy approach is yet another approach used by the Federal Reserve to jumpstart the economy. This particular round of economic stimulus will ensure that the financial system remains liquid by having enough cash available for short-term borrowing rates to remain normal. The less cash or liquid available in the economy, the higher the overnight borrowing rates will be, which spells trouble for the economy. The Fed have been using several economic stimulus approaches to try and jumpstart the U.S. economy for quite some time now. This proves to be another confirmation that the economy continues to struggle. The next stimulus approach will probably be the cutting of interest rate by 25 basis points this coming Wednesday. Please like, subscribe, and check the bell so you'll know when new weekly videos are uploaded. Mstardom Finance commercial break. Are you a successful Forex trader or a successful stock trader and want to gain even more success as a trader? Well, look no further than the Mstardom Finance weekly review of the U.S. economy. The weekly review comes in a video format and an article format. The video format, hosted by yours truly, Glenn Ford Robinson, can be seen on the Mstardom Finance YouTube channel. and the article format can be seen on the Mstardom Finance website at mstardom.com. For in-depth fundamental analysis of how to create a forex and a stock trading strategy using the data presented in our videos and articles, please contact 631-747-7237. I am Glenn Ford Robinson. I will be back next week with another edition of Weekly Review of the U.S. economy. Don't go anywhere. Disclaimer time. Information in this video and in our articles published on mstardom.com may contain forward-looking statements which could involve high risk and uncertainties. Markets and instruments profiled in our videos and our published articles are for informational purposes only and should never be taken as professional advice or recommendations to buy or sell in these assets. You should do your own in-depth research before making any investment decisions. Mstardom Finance does not guarantee that the information presented in our videos and articles is free from mistakes, errors, or material misstatements. It also does not guarantee that this information is timely in nature. Investing in open markets involves a high risk or a high degree of risk, including the loss of all or a portion of your investment, as well as emotional distress. All risk, losses, and costs associated with investing, including total loss of principal, are your responsibility. Thank you and goodbye.